Ladies and gentlemen, please welcome the interim president of the Federal Reserve Bank of Dallas, Meredith Black.
Thank you all for being with us here today. We're very pleased to welcome those of you who came from all over the world to the 2022 Annual Computing and Economics and Finance Conference, braving the Texas heat to be at these meetings and to come to this panel. I also want to thank all of those who are joining us online for this discussion. Today also marks an important milestone for many of us, as this is the first in-person panel and conference we've attended since the start of the pandemic. Before we get started, I'd like to express my sincere appreciation to everyone who helped make this event come together. I want to start with the Society for Computational Economics and its president, Herbert David, for their support and the many efforts to bring policymakers and academics together for this event. I would be remiss if I did not mention the contributors of the contributions of the local organizers, the Economics Department of Southern Methodist University, and the Research Department of the Federal Reserve Bank of Dallas. Special thanks to Nathan Balke at SMU and Enrique Martinez Garcia at the Dallas Fed for taking the lead in organizing our event, and also to the countless others who have done so much to make this happen. And of course, I want to thank the George W. Bush Presidential Center, its president and CEO, Kenneth Hirsch, and its staff, among others, the moderator of today's event, Cullum Clark, for their collaboration in organizing and physically hosting our event. We couldn't have done it without you. Last but not least, I would like to thank Governor Waller, Governor Wren, and former Vice Chair Cohn for graciously agreeing to contribute to this event with their time and their insights. Thank you all. This evening's panel will explore how monetary policy has been tested by the pandemic, the lessons learned by major central banks about monetary policy frameworks and their efficacy, and how the post-pandemic economy will likely evolve. I will now turn things over to Cullum Clark to introduce himself to all of you and introduce our distinguished panelists. I look forward to an insightful conversation that will follow. Thank you all.
Good afternoon, everyone, and thank you, President Black. On behalf of President and Mrs. Bush and my Bush Center colleagues, I'm honored to welcome you to the George W. Bush Presidential Center. Our mission at the Bush Center is to combine ideas and action to address some of the principal challenges of our time, ensuring opportunity for everyone in our economy, strengthening democracy, and advancing free societies around the world. I'm an economist, and I have the privilege of leading our domestic economic policy work at the George W. Bush Center. We're delighted to be partnering today with our friends at the Federal Reserve Bank of Dallas and SMU to host today's panel on monetary policy at the crossroads. It would be quite an understatement to note that the last 2 years have presented monetary policymakers with a variety of significant challenges. From the pandemic and the fiscal policy responses launched in countries around the world, to the war in Ukraine and continuing supply chain challenges. The world economy has seen an unprecedented mix of supply and demand shocks, one after the other. Meanwhile, both the Federal Reserve and the European Central Bank have undertaken major reviews of their monetary policy frameworks over the last couple years. The Federal Reserve announced substantial shifts to its long-term strategy framework in 2020, while the ECB followed suit with changes of its own, equally significant in 2021. In both cases, central bankers indicated that they will pursue symmetric medium-term inflation targets of 2%, viewing sustained deviations in either direction as equally undesirable. The emergence over the past year of the highest inflation rates in the last 40 years have quickly put these new policy frameworks to the test. Leaders of both the Federal Reserve and the ECB have made very clear their determination to bring inflation rates back down to target and avoid a creeping upward drift in the public's expectations for longer-term inflation. Just this past week, as everyone knows, the Federal Reserve announced another 75 basis point increase in its interest rate target, while the ECB announced its intention to move towards monetary tightening starting this summer. Our conversation today couldn't be more timely. This afternoon, we have the opportunity to hear from 3 leading central bankers. So here's how we will operate today. We'll start our session today by hearing a 15-minute or so presentation from each of our panelists, whom I will introduce in turn. We'll then have about 40 minutes for a discussion that I'll moderate. Please note that conference participants have all had an opportunity to submit questions in advance, which I've done my best to incorporate. We will not, however, take real-time questions from the audience today. I'll also note that today's panel is being broadcast live through the Dallas Fed's YouTube channel, and that a recorded version will be available there after the event today. So with these housekeeping details out of the way, it is my great honor to introduce our first speaker. Dr. Christopher Waller currently serves as a member of the Federal Reserve's Board of Governors. Before joining the Board of Governors in 2020, Dr. Waller served as Executive Vice President and Director of Research at the Federal Reserve Bank of St. Louis for 11 years. He has also worked as an academic economist at Notre Dame and the University of Kentucky, and has published substantial research on macroeconomic and monetary theory. So without further ado, I'm honored to introduce Dr. Waller.
Well, thank you all for showing up on a Saturday afternoon. Well, thank you to Meredith and Cullum, and thank you to the Society for the invitation to speak to you today. This week, the Federal Open Market Committee, or FOMC, took another significant step toward achieving our inflation objective by raising the federal funds target rate by 75 basis points. In my view, and I speak only for myself, if the data comes in as I expect, I will support a similar size move at our July FOMC meeting. The Fed is all in on reestablishing price stability, and part of that effort involves understanding the forces that have boosted inflation and examining how policymakers responded. So today I intend to look back on monetary policy in 2020 and 2021, as I have before in some recent speeches, but go a bit further and try to discern some lessons learned. In addition to the Federal Reserve's emergency lending programs, the monetary policy actions taken during this time were deemed extraordinary. We swiftly lowered the target range for the federal funds rate to close to zero, the effective lower bound, and made an open-ended commitment to purchasing securities. It was only the second time that the Fed had taken such dramatic steps. But the first time for these actions was scarcely a decade ago, and there's good reason to think such a response may not be extraordinary anymore. Structural changes in the economy have tended to lower interest rates and limit the room that the Federal Reserve will have to cut rates during a slowdown. I hope we never have another 2 years like 2020 and 2021. But because of the low interest rate environment we now face, I believe that even in a typical recession, there is a decent chance that we will be considering policy decisions in the future similar to those we made over the last 2 years. Because of that likelihood, it is especially useful to consider the lessons learned from the last 2 years. Let's start at the beginning. When the United States was faced with the economic shock from COVID-19, over several weeks, starting in early March 2020, the FOMC lowered the target range for the federal funds rate to the effective lower bound and began purchasing treasuries and agency mortgage-backed securities, or MBS. Meanwhile, the Fed established numerous liquidity and credit market facilities. All of these actions were taken to support liquidity in the financial system and keep credit flowing to households, businesses, and state and local governments. Asset purchases were undertaken in response to disruptions in financial markets, particularly in the normally stable U.S. Treasury market. Besides supporting smooth market functioning, asset purchases also aided in the transmission of monetary policy to broader financial conditions. Financial markets stabilized relatively quickly. Over the course of 2020, the Fed's liquidity and credit facilities saw reduced demand, and most of the emergency programs were decommissioned around year-end of 2020. So perhaps the most forward takeaway for monetary policy is that in times of severe stress, lending facilities, along with sharp cuts to the federal funds rate and the introduction of large-scale asset purchases, are very effective in reviving the economy. There are some other lessons, I think, from the experience of tightening monetary policy, a process which was put in motion by the guidance that the FOMC issued in 2020 about how long it would keep the federal funds rate at the effective lower bound and continue asset purchases. In September and December of 2020, the FOMC provided criteria or conditions in the meeting statement that would need to be met before the FOMC would consider raising interest rates and begin to reduce asset purchases, respectively. These conditions were, in effect, the FOMC's plan for starting the process of tightening policy. This guidance was short-term, specific to the task of when to tighten policy in this current cycle, and focused on specific tools. Let me make an important distinction here. A bit earlier, in August of 2020, the committee completed a multi-year review of our overall strategy for achieving and sustaining our economic goals. The strategy statement is very different than the tightening guidance that we gave in September and December of 2020. It is about longer-term goals, not specific actions related to the current circumstances. The goals in the strategy statement apply in all economic circumstances and don't include any details on the setting of policy tools. I mention this distinction because some have argued that the FOMC's new strategy was a factor that led the FOMC to wait too long to begin tightening monetary policy. A bit later, I'll explain why I do not believe this is the case, and I will explain how the guidance for tightening monetary policy laid out in the FOMC's post-meeting statements was the basis for our decisions. So let's think about how the economy evolved and how the criteria for that guidance steered the path of policy. In early 2021, the committee began noting whether the economy was making progress toward our employment and inflation goals, and thus getting closer to decisions on unwinding our highly accommodative monetary policy. Based on our positive experience with unwinding after the global financial crisis, or GFC, we thought it would be appropriate to use the same sequence of steps. First, taper asset purchases until they stopped, then lift off rates from the effective lower bound, and then eventually and gradually and passively reduce our balance sheet by redeeming maturing securities. Most importantly, through various communications, we made it clear that tapering of asset purchases would have to be completed before rate liftoff to avoid the conflict that would occur by easing with asset purchases while raising rates. Now, in the previous episode of policy tightening after extraordinary accommodation, this process was very gradual. Tapering of assets took 14 months. And then the first rate hike did not occur until more than a year after asset purchases ended. Balance sheet reduction began more than a year and a half after that. So this gradualism in these steps of normalizing policy worked well then, and it surely influenced the committee's approach this time. Implementing this approach required two pieces of guidance. First, we had to lay out criteria for beginning the tapering process. And second, criteria to begin raising the policy rate from the effective lower bound. Through explicit language in FOMC statements, we told the public the necessary conditions that needed to be met before we would adjust these two policies. For asset purchases, the committee declared that tapering would wait until substantial further progress has been made toward the committee's maximum employment and price stability goal. Substantial progress. It did not say achieve the goals. Meanwhile, the FOMC said that it would keep rates near zero until our employment goals had been reached and until inflation had reached 2% and was on track to moderately exceed 2% for some time. So there was this implicit belief that there was a gap between when you would start tapering, when you would possibly lift off, and that tapering would end long before we would lift off. Now, a fair question is, what do these words mean? Okay. How do you operationalize them? And in particular, what did the phrases substantial further progress for tapering and for some time for liftoff mean? In large part, the interpretation hinged on how the committee viewed how the economy would recover from the pandemic. Looking across forecasts at the time by committee participants in the private sector, no one expected substantial progress toward our goals to happen very soon. The economy had begun to recover, but at the end of 2020, COVID was bad and getting worse. Vaccines were just arriving, so we didn't know how soon schools would reopen and people would get back to work. In November and December of 2020, the unemployment rate was 6.7%, and inflation seemed to be in check. 12-month total PCE inflation was declining, and core inflation, which excludes volatile energy and food prices, was more or less steady at 1.5%. The summary of economic projections by FOMC participants in the December of 2022 meeting had the unemployment rate moving down to 4.2% at the end of 2022, and inflation moving up to 2% only in 2023, if only. Only one participant had liftoff occurring by the end of 2022. So based on this SEP, if you just look at those projections, the committee did not expect the economy to recover quickly. And looking at the Federal Reserve Bank of New York's survey of primary dealers back in January of 2021, the median respondent thought tapering would start in the first quarter of 2022. The median respondent and liftoff wouldn't end until 2023. So start in 2022, end in 2023. That was what the markets thought. To move forward, policymakers had to evaluate substantial further progress and for some time. The phrases admittedly are not concrete in their meaning. Inflation averaging doesn't define how much above 2% is moderate and how long some value of elevated inflation should be tolerated. In addition, for assessing progress in the health of the labor market, different policymakers will prefer different measures that may not provide the exact same signal. On top of this, the data used to measure progress in the labor market can revise substantially and reshape the evaluation of the strength of this market quite quickly. For example, a key input, payroll data, in the later half of 2021 painted a picture of a slowing labor market. But revised data over several subsequent months revealed the slowdown never happened. Instead, job gains were very robust. In particular, initial reports of job creation between August and December were a cumulative 1.4 million, and by February that number was revised up to 2.9 million, doubling what we thought it was. So overall, the economy evolved rapidly in 2021. I don't want to get into month-to-month details as I have in other speeches, but by October and November, policymakers thought the economy had improved enough to meet the criteria to start tapering at the early November meeting, so earlier than the markets had originally thought. Then later that month, data indicated inflation was accelerating, so the committee hastened the pace of tapering at the December meeting, making plans to wind down purchases by March of this year. Between December and March of this year, inflation came in very elevated, and at that point, there was no question that inflation had been above 2% for some time. Given continued improvement in the labor market and the high inflation readings, the committee began raising interest rates in March as soon as asset purchases were completed and started balance sheet runoff the next meeting. So ending, raise, runoff. Not these long gaps that had happened previously. So with these actions in the rearview mirror, we can now ask, knowing what we know now, should we have done anything differently? To be clear, by asking this question, my intent is not to criticize the decision of the committee. Rather, it is to assess our policy strategies should we be confronted with another crisis in the future. So one question to ask is whether the guidance we issued was too restrictive. In other words, did it allow enough flexibility for the FOMC to begin raising the policy rate when it was appropriate? Recall, we had decided that raising the policy rate would not occur until the tapering of asset purchases had finished. But to finish, tapering's got to start. And for a given pace of tapering, the longer it takes to start, the longer it will be before you can raise the policy rate. Now, of course, one can keep the liftoff date fixed and simply taper at a faster pace, including the possibility of a hard stop of asset purchases. But concerns about financial market functioning, including the ability of markets to absorb the purchases that the Fed was making, typically limits how fast tapering can be done, particularly given the amount of asset purchases we were doing, $120 billion per month. You were suddenly turning over to the private market and say, now buy it. So given the tapering criteria and subsequent data, we ultimately had to pivot hard to accelerate the tapering pace, and in fact, completed the tapering of purchases just a few days before we lifted off, not a year later. Unlike the normalization timeline after the financial crisis, we did not have the flexibility to raise the target rate sooner. However, if we had less restrictive tapering criteria and had started tapering sooner, the committee could have had more flexibility on when to begin raising rates when inflation reared its ugly head. So by requiring substantial further progress toward maximum employment to even begin the process of tightening policy, one may argue that it locked the committee into holding the policy rate at the zero lower bound longer than was optimal. So my takeaway is that a less restrictive tapering criteria would have allowed more flexibility to taper sooner and gradually, as opposed to relatively later and faster approach that occurred. Experience has shown that markets need time to adjust to a turn from accommodation to tightening, and that surely was a factor for FOMC's statements over the years in framing criteria for key policy actions during their recovery from the GFC and the pandemic. So I'm supportive of issuing such criteria, but we need to be careful to use language that allows the committee the flexibility it needs to respond to changing economic and financial conditions. Now let's turn to the liftoff criteria. It also was quite restrictive. The liftoff criteria required the economy to be in a situation where our dual mandate had been achieved. Not making progress, had been achieved. Now, it can be argued that this meant getting the economy back to its 2019 state with very low unemployment and inflation near 2%. But when we were in that state in 2019, the policy rate was well above zero and closer to its neutral value. It was not at zero. Consequently, if the state of the economy is telling you to be at neutral and you are at zero, then any Taylor rule would say the policy rate needs to rise much faster than was typically done in the past. So if you're going to wait that long, it's got to go like that to get back to neutral. So it should not have been a surprise that the policy rate would rise fast in 2022. Rate hikes would need to be larger and more frequent relative to the 2015-2018 tightening pace to get back to neutral. So looking back, should the committee have signaled a steeper rate path once the liftoff criteria had been met? Perhaps another lesson is that giving forward guidance about liftoff should also include forward guidance about the possible path of the policy rate once you lift off. In closing, I hope that our country is not faced with another crisis as severe as the one precipitated by COVID, and that the Fed is not faced with the challenges of setting monetary policy under such conditions. But if we again face those challenges, we now have the additional insight that only experience can bring. I hope that this latest experience will help us approach the future with a more complete understanding of the policy choices and trade-offs that we face. Thank you.
Thank you, Governor Waller. It's now my honor to introduce our next speaker. Dr. Olli Rehn currently serves as Governor of the Bank of Finland and is a member of the Governing Council of the European Central Bank. Dr. Rehn's career before joining the Central Bank in 2017 included serving as Finland's Minister of Economic Affairs, Vice President of the European Commission, responsible for economic and monetary affairs, and member of the Finnish and European parliaments. Ladies and gentlemen, Dr. Olli Rehn.
Thank you, Callum. Good afternoon, everybody, dear colleagues, ladies and gentlemen. It is my honor and great pleasure to be with you here in Dallas today. To the organizers, many thanks for the invitation to join the conference and this panel, the themes of which are most topical. It is indeed pertinent to explore central banks' recent reviews of their monetary policy frameworks, as Dr. Waller just has done in a very analytical way, and how monetary policy has passed the tests of recent crises, including, of course, the COVID-19 pandemic and Russia's war in Ukraine. I should say that I'm here in my capacity as a member of the Governing Council of the European Central Bank, and so the views I express are built on this experience mostly. I should also add that I'm speaking as a member of the Governing Council rather than on its behalf. We know that monetary policy makers are currently facing challenges that seemed quite unlikely or distant even just 1 year ago. After a long decade of very low inflation, we moved last year very quickly to a period of very high inflation. This does indeed challenge our analysis and our thinking in various ways. Recently, there has been much talk about a regime change in monetary policy. Dictionaries typically define regime change as, quote, a persistent change in the structure and function of a system, unquote. For political scientists, this term has a very specific meaning, i.e. a profound change or replacement of one government regime with another, referring to the nature of the political system, be it democracy, autocracy versus tyranny for Plato, or principality versus republican government are in lowercase for Machiavelli. So while there is no doubt that monetary policy is at a crossroads today, we should ask if it really is about a monetary policy regime change. I doubt that. Instead, the ongoing policy normalization is a response to the rapidly, even dramatically changed inflation outlook. As to the European Central Bank, our strategy and monetary policy framework was reviewed and revised a year ago in July 21, and the new revised strategy remains valid. We are determined to deliver on our symmetric target of 2% inflation in the medium term. I'll come back to that shortly, but let me say a few words about the current economic and inflation outlook. Russia's brutal, illegal war in Ukraine has profoundly transformed the European security order as well as the economic policy landscape and has global ramifications. As an expression of European unity and Europe's firm support for Ukraine, the European Commission yesterday recommended candidate status for Ukraine, which is a first critical, important step in Ukraine's journey towards membership in the European Union. And I trust that the EU leaders will soon endorse this recommendation. Before the war broke out, the Eurozone economy had recovered from the pandemic better than expected. As you may see from this graph, the red dotted line is our forecast of the ECB in June 2020 in the first rock bottom of pandemic, and the blue line is the realized economic activity, and you can see that it was clearly better than expected 2 years ago, and we were on the trend we were on the way of reaching the previous pre-pandemic trend in 2023. Now, while Russia's share of the world economy is fairly small, less than 2%, knock-on effects of the war are amplifying the supply bottlenecks and impacting energy, commodity and food prices. These headwinds will weigh on confidence and dampen growth in the near term, but once they abate, economic activity is expected to pick up again. Our forecast is slightly below 3% growth for this year for the Eurozone and around 2% for next year and the following year, i.e. the years 23 and 24. Like here in the United States, the inflation outlook is ever more challenging also for the Eurozone, with headline inflation accelerating above 8% last month in May. Currently, we have a very clear driver and likewise a very clear anchor for inflation dynamics in the Eurozone. The driver is, of course, energy inflation, as fuel prices have steeply increased since last summer, and they explain around half of total consumer price inflation. The anchor is a relatively moderate level of wage inflation, at least until recently. Let me elaborate a bit more detail on these. While Eurozone inflation has risen mainly because of surging energy and food prices and other commodity prices, inflationary pressures have recently broadened and intensified. The latest ECB projections from last week forecast an annual Eurozone inflation rate of 6.8%, which is projected to decline to 3.5% in 23 and to 2.1% in 24. This implies that headline inflation at the end of the projection horizon is thus expected to be only slightly above the ECB's target of 2%. I should underline that energy inflation and supply chain bottlenecks alone would not lead to a sustained acceleration of inflation unless they lead to second-round effects. In the medium term, the critical question is whether the rising energy prices will raise inflation expectations and wage demands, thus leading to a wage price spiral. So far, while wage growth has started to pick up in the Eurozone, in some countries more than others, the situation is still different from that in the United States. Our labor market is holding up well, and unemployment is at a 40-year low at 6.8% on average in the Eurozone. But there is still slack, and the labor market is clearly not running red hot. Wage growth this year has risen from around 2%, say late last year, to roughly 3% at an annual rate, but this does not yet equal to or imply an outright second round wage price spiral. For the sake of comparison, wage growth in the US has been in excess of 5% recently on average, and much higher in some sectors. Having said that, of course, also in the Eurozone, we must be mindful of not letting inflation expectations become unanchored, and this has led to policy action since the end of last year. As evidence was increasingly pointing to a major upward shift in inflation, the ECB started the process of gradual policy normalization last December. As a first step, we ended net asset purchases under the Pandemic Emergency Purchase Programme, PEPP, in March, and we've been preparing the markets with forward guidance for the end of net asset purchases under the general APP asset purchase program and for a subsequent rate lift-off. And this is very much linked to our revised strategy. Our new strategy has enabled us to pursue a consistent, orderly process of policy normalization, which we continue to conduct. And responding to the panel's, research question, it is fair to say that the ECB strategy review was a critical turning point in the making of monetary policy in the Eurozone. It was the final step in the ECB evolution to a modern central bank, a process that truly proceeded with speed and effect since the then ECB President Mario Draghi's whatever it takes speech in London 10 years ago in July 2012, during the deepest moments of the euro crisis. Let's recall that when we started the strategy review, the Eurozone was in a prolonged period of excessively low inflation or lowflation. Headline inflation had averaged 1.1% since 2012, and core inflation just 1%. Our analysis was that the R-star, or the neutral natural interest rate, equilibrium interest rate, had declined substantially in the past 20 years. Hence, the new strategy was worked out in a disinflationary environment. The ECB Governing Council decided that price stability is best maintained by a 2% symmetric inflation target over the medium term, while the previous target was often considered a ceiling that is below but close to 2%. That was understood as a ceiling, and that was not very conducive for rational monetary policy in the zero lower bound or effective lower bound environment. The current target is clearly symmetric in the sense that we consider both negative and positive deviations from the 2% target to be equally undesirable. After the completion of the strategy review, the speed of change in the operating environment has been accelerating. I'll tell you one example of this. It was still one example of how the mindsets have changed in only 1 year. It was still less than a year ago, I recall, that some commentators were skeptical about whether the Eurozone would ever pull away from the low inflation era. There was much talk about Japanification of the Eurozone. Well, we don't hear such talk too much anymore. In the current context, the risk of deflation has obviously vanished, at least for some time. But we face another challenge in preventing inflation expectations from becoming unanchored. Indicators of underlying or core inflation have been rising rapidly this year, and inflation expectations have been shifting upwards. That's why the ECB's first interest rate hike in over a decade will take place soon. And that was indeed the message we conveyed after the ECB monetary policy meeting on June 9th. The end of net purchases under the APP program on July 1st will pave the way for a rate lift-off at our next rate-setting meeting in July, in line with our forward guidance. Based on the current outlook, we are likely to be able to exit negative territory in interest rates by the end of the third quarter. Monetary policy cannot do much about rising energy prices, but it can influence inflation expectations to stay anchored around the target. That is, we, the central banks, have the means to maintain price stability, and as shown earlier this week by the Fed, we clearly have the will to do so. Before concluding, let me briefly comment on the risk of financial fragmentation in the Eurozone, which is a word used, for instance, for the widening of spreads between the so-called periphery and core countries. Flexibility in the conduct of asset purchases has helped us counter any impaired transmission of monetary policy. This was demonstrated by the PEP program during the pandemic, and flexibility will firmly remain in our policy toolbox. The reinvestment capacity that we have under the PEP today totals 1.7 trillion euros, and it will be reinvested in a flexible manner across time, across jurisdictions, across products. Moreover, we decided to accelerate the completion of the design of a new anti-fragmentation instrument. In the case of more profound structural economic weaknesses and debt sustainability problems, there is always the option to activate outright monetary transactions, which would be preceded by a program of the European Stability Mechanism. The OMT program was created in August-September 2012 to operationalize Draghi's whatever it takes speech, which helped greatly to put a stop to the Eurozone debt crisis. Dear colleagues, ladies and gentlemen, let me conclude by stressing the relevance of our strategy review for the ECB's contemporary and future monetary policy. Even though the strategy was worked out during the not-so-distant lowflation era, it has served us well also in the rapidly changing operating environment. Going forward, we will lean on the new revised strategy in order to proceed simultaneously, i.e. in parallel with both the consistent, orderly, gradual normalization of monetary policy on one hand, and the necessary measures for containing unwarranted financial fragmentation on the other. And trust me that we have both the instruments and at least equally important, the firm will to make sure that Eurozone inflation stabilizes at its 2% target over the medium term. Thank you very much for your kind attention.
Thank you, Governor Wren. It's now my honor to introduce our third speaker. Dr. Donald Cohn is a 40-year veteran of the Federal Reserve System, serving as a member and then as vice chair of the Board of Governors from 2002 to 2010. Dr. Cohn played a key role in the Fed's response to the global financial crisis of 2007 to 2009 as a top advisor to Chairman Ben Bernanke. He currently holds the Robert V. Rosa Chair in International Economics at the Brookings Institution. Dr. Cohn had certainly intended to be here today with you, but like countless people, he was held up by insurmountable air traffic challenges today. So he's joining us on the big screen, the medium-sized screen over there from his home. So Dr. Cohn, and let me say one last thing really fast, and that is there was a very big, fast, last-minute scramble to make all this work, and I want to thank my Bush Center colleagues who went over and above to make it all work. So Dr. Cohn, it's all yours.
Thank you, Callum. And I want to join you in thanking your Bush Center colleagues for making it possible for me to participate. I'm really sorry that I don't get to talk personally with Uli and Chris, but I hope the participation will go well this way. We certainly have plenty of practice at this sort of thing. So I think Callum has framed a good set of questions for us. I want to abuse my privilege here as a member of the panel and reframe it. As I was thinking about this, I thought of an interview that Paul Volcker did of me before a group of international students in the middle of the financial crisis, just as we were recovering. It was either late 2010 or early 2011. And he asked me two questions, which I thought got right to the heart of what we were doing. The first question was, how did we get into this mess? And the second question was, how are we going to get out? So I thought I would frame my contribution here to those two questions. And I thought we've had some really valuable guidance and focus from Chris and Uli there on this. So I'll be repeating some of what they did. So how did we get into this mess? I think we can't, bad luck produced a set of adverse shocks to supply and a difficult policy environment. I think policy misjudgments, not just by the Federal Reserve or the ECB, and my focus will be on the Federal Reserve here because that's what I know best. Policy misjudgments contributed to that reduced supply being met with very strong demand. So let's look at the bad luck. And I think both Chris and Uli have mentioned these things. So I think it's critical to remind ourselves of the extremely difficult circumstances facing policymakers. We had two nearly unprecedented events, COVID, which basically global pandemic, unprecedented at least for 100 years, and this reduction of food and energy supplies that Uli was emphasizing, resulting from a war of aggression. The COVID stuff was very difficult to predict as it evolved. COVID initially shut down the economic system. Both supply, production side and the demand side shut down. The policymakers were dealing with an unpredictable virus and unpredictable behavioral and governmental responses to that virus. As people learned to live with COVID and the vaccines became more widely available, demand bounced back more quickly than supply. I mean, as constraints came off, there was a natural tendency to resume activity, including purchasing activity, but waves of variants produced continuing supply-side constraints on labor force participation in the US and in supply chains from China and other places owing to the shutdowns over there. Those supply chain disruptions were focused on the supply of goods, which was where much of the demand was focused for some time. So that exacerbated those price pressures early on. Now, demand strength was certainly aided and abetted by stimulative fiscal and monetary policies, and I want to come back to that in a second. So into this COVID policy-led imbalance came the invasion of Ukraine with its cutoff of major sources of food and fuel supplies from both Russia and Ukraine. And we need to keep in mind that a lot of what's driving gasoline prices, inflation expectations, and inflation itself right now, and is results from that invasion, as Uli was, and hits Europe much harder than the US, as Uli was correctly emphasizing, And these higher prices are eroding real incomes. That was ongoing before the invasion, but it certainly has gotten worse. The Fed or the administration can't do much about these prices. Many of them are determined on global markets, insensitive to financial conditions, and the response of the West, of Europe and the US and others to the aggression, to the Russian aggression, was absolutely spot on to engage in those sanctions and cut off those supplies. Often a central bank can look through these sorts of supply shocks, view them as a price level change, not inflation per se. But when things like the food and energy increases that have occurred recently occur in the midst of already inflationary conditions, they raise the risk of second round effects on expectations, wage and price setting, and that adds to the imperative to do something about inflation. How and why were these policy misjudgments made? Why were there such stimulative policies extended well into 2021 as the economy was rebounding? I think Chris Waller gave us a very helpful reminder of the data as it was coming in and the difficulty of making predictions, not only by government authorities, but by private sectors also. So this looking back with 2020 hindsight is not entirely fair to the policymakers. They were working with the data they had when they did. I think, but in the case of both fiscal and monetary policy, policymakers were reacting to lessons learned from the recovery from the global financial crisis of 2008, 2009. There we had sluggish, persistent, high unemployment. The recovery was hampered by restrictive fiscal policy after the initial round of stimulus, right after President Obama took office. And I think hence the double down on the fiscal stimulus, particularly early in the Biden administration, partly because that also gave them a chance to initiate some programs by the newly empowered Democrats, some programs that they favored. So fiscal policy, trying not to repeat what they saw as the mistakes of 2010, 11, 12, 13. So why didn't the Fed counterbalance this extra push from fiscal policy? I think the Fed, first of all, as Governor Waller was saying, the data coming in didn't suggest the need to counterbalance this until very late in the period, till very recently. But I also think there was the Fed was also taking its lessons from the 2010s, from the response to the global the rebound from the global financial crisis. Not only was there a weak recovery, but as Oli just reminded us, inflation in Europe, but also in the US, fell well short of the 2% target. And you had persistent low interest rates that threatened to constrain any response to future recessions or negative shocks. So the concerns about inflation are that be too low and not too high. This concern about low interest rates and low inflation was reflected in the framework review that the Federal Reserve did of policy strategy. And that framework review contained a number of asymmetries. I think, Callum, you characterize this as symmetrical policy, but the strategy, and it is symmetrical around 2%, both places, but the strategy had a number of asymmetries that tilted in favor of high inflation, partly to offset the disinflationary asymmetries of the effective lower bounds and the experience of the 2010s. First of all, the new framework was going to make up for undershoots of inflation from 2%, but apparently not for overshoots of inflation. That's one asymmetry. Secondly, under the new strategy framework, the Fed was not going to act preemptively against high inflation, just low inflation. They would predict the inflation declining when employment was below full employment, but not to inflation rising when employment was above full employment until inflation was already high. And it emphasized strong labor markets. So as between the dual mandate of price stability and strong labor markets, there was much more emphasis on strong labor markets and the use of broad-based and inclusive measures of labor market strength, new measures of strength. Now, I agree with Governor Waller that perhaps we can argue about whether the strategy led them where they were, but I think and more than the forward guidance, I think the forward guidance itself, as he emphasized and took valuable lessons from, did lead to a delay in working against inflation as it became more evident. But I do think the guidance itself, I guess, Chris, where I would love to be in person and have this discussion, the guidance itself reflected, in my mind, the same kind of mindset that the strategy grew from, which is we don't really need to worry about high inflation. We need to lower about low inflation, and we need to make sure the real strength of the progress on labor markets, which you discussed both for tapering and to lift off, to be at full employment when you're lifting off, that is to build in negative interest rates when you get to full employment, is a pretty aggressive policy. And at the same time, I think the Fed's view of how to measure labor market full employment evolved over time. So there was a lot of emphasis on labor force participation, which was held back by COVID at the beginning and unemployment rates, and only gradually did the Federal Reserve begin to focus on vacancies and the churn in the labor market and the very rapid increase in wages. So I think in sum, the new framework plus the forward guidance were built for disinflationary times, didn't really contemplate persistent inflation pressures. And a lesson here that I took from it is that we need to stress test strategies and strategy frameworks and forward guidance against unusual developments and be prepared to pivot and to think in advance what would happen if things didn't come. The Federal Reserve and other authorities stress test banks against highly unusual outcomes. I think stress testing your own policy against highly unusual outcomes would have been helpful. So the second question Paul Volcker asked me was, how are we going to get out of this mess? Here, I think the role of the administration and Congress is very limited. They can work around the margins on supply, in my view, including increasing legal immigration, taking down some of those tariffs, reducing some of the tariffs that President Trump put in place, and not make inflation worse by pushing expenditures that aren't paid for. So, and also make sure that as you're regulating, you weigh the costs and benefits, and among the costs might be a disincentive for expanding production. So get out of the way on the supply side, increase it where you can. But primarily, this is on the Fed. And the Fed is the one who has responsibility for price stability. And in my view, they are now on the right track. I think one point I would make before discussing the specific steps they've taken is what I really liked about Governor Waller's discussion, along with many of his colleagues, was that they admitted mistakes. How many government agencies stand up there and say, we were wrong? But the Fed did. The Fed did, and engaged in a vigorous and open debate about what needed to be done. So I think the culture of the Federal Reserve helped to foster the kinds of steps that they have now taken to deal with the problem. And so they finished the taper, they accelerated the taper, they accelerated the liftoff, they've increased the trajectory of the liftoff, as Governor Waller was telling us. So I think these steps are important. They've narrowed the focus to inflation. They're not worrying about the labor market. They changed their announcement to make that very clear that they're really just focused on inflation now. Labor market is exceptionally strong in any event. They're moving expeditiously to remove the extraordinary degree of monetary accommodation put in place when the pandemic hit. They've allowed the portfolio to decline. They've raised interest rates towards less clearly accommodative levels. And I think importantly, in the last set of projections, they are realistic and transparent about what's required to damp demand to relieve pressure on labor markets and reduce inflation. The last set of projections had modestly restrictive, moved towards a modestly restrictive stance of monetary policy in order to damp growth and hold it to below potential and raise the unemployment rate. They still could be optimistic about avoiding a recession, but I think it was very encouraging that they realized what needed to happen. Realizing getting inflation back into the 2% areas, as the projections have by 2023 and 2024, requires inflation expectations to remain anchored and some help from the supply side, at least no repeated supply disruptions. And you can see why they took the step that they did, because there are hints that expectations might be becoming unanchored. Now, I think one can have a bit of a different concern over time. Not right now. I think they're doing the right thing right now. But I want to, they have a reaction function keyed to the very big changes in their policy rate, keyed to incoming inflation data. Incoming inflation data lag the effects of monetary policy. And that's exactly what's required right now. But if that kind of reaction function is maintained, it practically guarantees overshooting and unnecessary weakness in the economy, especially if there are further supply side disruptions, which, as Jay Powell emphasized, aren't under control. And I want to finish with another Volcker reference. So everybody talks about the Volcker moment of October 6, 1979, when the structure of monetary policy, the strategy and structure of implementation of policy was changed to fight inflation. And that was important, critical to establishing really several decades of strong growth in the United States, strong price stability and strong growth. I think there was a second Volcker moment that gets less publicity, but is also important. And that occurred in the summer and fall of 1982. And Paul Volcker said, we've already got the economy in recession. Inflation is down. It was only down, I think, to about 4%. So it's still pretty high, but he said enough. So we've accomplished a lot. The costs of continuing on this process outweigh the gains. There were problems in Latin American debt that were feeding back on US banks, as well as a very high unemployment rate. And even though the structure that had been put in place on October 6, 1979, the money growth reserve structure that had been put in place dictated increases in interest rates in the fall of 1982, Paul Volcker said, now that's enough. And I think it requires judgment and confidence to know when to back off. And that's going to be the next challenge for the Federal Reserve. I'm sure Chris Waller is anxious to get to that moment when inflation comes down enough you can actually talk about that. But I think it's worth keeping in the back of your mind as you outline the forward guidance for what you're going to do with interest rates going forward. Thank you, Callum. That concludes my prepared remarks.
Well, we'll invite our audience to the stage. Thank you, Dr. Cohn. I think you certainly set the stage for an interesting conversation during the minutes we have together here. So I'd like to take you up right on the challenge that you suggested earlier, to go back to the framework review. Of course, the main idea, as I understand it, is that if we're to anchor public expectations over the long term for inflation at 2%, it requires some degree of symmetry. And yet you've suggested there, Dr. Cohn, you've suggested that there is, in a sense, has been asymmetry built into the system that maybe was kind of implicit, and you suggested a conversation, particularly with Governor Waller, on it. So Governor Waller, could you offer your thoughts on what Dr. Cohn had to say?
Well, I mean, the fact was that we had a 2% inflation target. I believe we put it in place in 2012. And then for a decade, we underran it, which was kind of unbelievable that you could underrun a 2% inflation target for 10 years. So there was just a general sense that there was something fundamental that was driving inflation to be below 2%. And the concern we had was that people didn't believe this was a target, they believed it was a ceiling. And if it's a ceiling, they believe you're never going to let it run above 2% to offset the underruns. So what we started seeing at the end of 2018-19 was inflation expectations in the market started to drift down. Not greatly, but just slowly and steadily started to drift down. And the feeling is we're losing credibility in the target if we don't do something to try to get policy to get to 2% kind of on average. So the framework was really designed to say, hey, honestly, we're going to let it go above 2%. Okay, and in fact, we'll let it run over for a while. So that was kind of the whole idea of this framework that we adopted. So it was just to try to get inflation expectations back up towards 2% and get people to quit thinking of it as a ceiling, and it truly was a target that we were willing to let inflation go above.
Governor Wren, could you comment as well on the idea you all also, of course, at the ECB have a symmetric target? Dr. Cohn's critique might well apply to the ECB as well. Your thoughts?
I would agree with Don on this and Chris as well. Prior to the strategy review, which we started actually just before COVID pandemic, but we had to delay the action, the active part of it because of the COVID crisis. So we restarted it in the fall of 2020 and completed it in 2021. And there were two main, one cornerstone and one reference. The cornerstone was the EU treaty, which defines price stability as the primary objective of the European Central Bank. And the reference was obviously the Fed's new strategy, the flexible form of average inflation targeting, which Chair Powell announced in August 2020 at Jackson Hole. And our situation was in a way even worse than the Fed because we were very constrained with the formulation of below but close to 2%. And we don't have a formal dual mandate. So what we did was revise the strategy, and after lengthy and intensive discussions, we could agree unanimously that we will have a symmetric target of 2%. We accept deviations up and down temporarily, and we have a medium-term orientation, which I think is a very important aspect, so that de facto, in reality, the ECB's mandate or framework is very close to the one of Fed in a sense that while of course our primary goal is price stability, but we target other important policy objectives such as full employment, sustainable development, balanced growth, as long as they don't conflict with price stability. And the medium-term orientation enables this to happen.
Dr. Cohn, would you add anything in view of what your colleagues here?
No, I think I agree that the two new frameworks are well adapted to the disinflationary environment that we faced in the 2010s. And in the US, anyhow, we were able to get to much lower levels of unemployment than anyone thought with very little inflationary feedback. So I think that it was well adapted to what they were seeing, but it was incomplete because no one apparently asked, and even the people like myself who were thinking about it after it was announced didn't ask, well, what would happen if the 2010s aren't repeated? And so I think that's, the Fed has said it's going to re-examine their framework every 5 years. So in another year or two, they'll have to take a look at it. I think, Governor Waller, you going to have to read it very carefully to vote on it again in January after what's happened. So there might be a little bit of a reexamination even before 5 years are out. So my only point is that it was good for one thing, it wasn't good for another, and the lesson is you got to think, bro. You have to have a complete strategy.
I'd love now to ask really a couple of questions about the lessons that you all have been speaking to from this unusual experience of the last couple of years. So, Governor Waller, start with you on this one. You suggested in your remarks the idea that maybe one thing we have learned is that if the economy is on the inflation and on the unemployment target and the rate is well below the neutral rate, that fast increases back to the neutral rate may actually be sort of called for as a kind of a normal response under those circumstances. Would you add any color on that?
Well, yeah, I mean, the tradition in central banking, Don knows more about central banking, has more experience than I have in his little finger than I have in my whole body. So he's probably the better person to talk about this. But the kind of the norm is to go raise rates in a gradual 25 basis point pace. It could be every meeting, maybe every other meeting, but this is kind of the normal behavior that markets tend to come to expect. Now, back in '94, of course, Greenspan went through this famous era of, a bunch of 50 basis point hikes, one 75 basis point hike, and then it never happened again after that. It was pretty much very steady, and so that's kind of the normal way that people think about policy. But if you're going to lay out this explicit objective of we're going to hit our targets and we're still at zero, then if neutral's at like 2.5 and you're at zero, you got to get to 2.5 in a hurry. You can't wait very long. And so I think this is where, I've had these discussions with economists who are asking me this. Why don't you just go up at like 100 basis points, 2 meetings in a row? Just get there. It's like, well, I think the markets would have a heart attack. So, we try to signal this in advance. One of the greatest things, as part as an academic at central bank, one of the greatest things coming out of the academic literature in the last 25, 30 years is the importance and the use of forward guidance. I mean, this is an amazingly powerful tool that we use to guide markets. We take into account markets being fairly efficient, that if we give them the info, they price it in immediately. Okay, we don't have to actually take the action. We just promise the action and the markets respond to that. So this has been something that came out of the academic literature in the 90s, the whole importance of forward guidance, and we've used it incredibly well, actually, up till now. But with forward guidance, at some point, you got to carry out the actions. You can't just keep promising the actions and promising the action. You got to actually do it. And so we're at that stage now, is we have to move rates a lot to kind of get back to neutral, and then in restrictive territory to get inflation back down.
When you bring up the possibility of the markets having a heart attack, I'm trying to figure out what they actually have done recently. It's more than a headache, I think. Aspirin alone may not do the job. Dr. Wren, let me ask you the same question in the context of Europe. The traditional idea that gradual moves are essentially how central banks have done business versus what Governor Waller just said. What are your thoughts?
Well, I think first commenting on Don concerning which lessons we took when we did the review, and our approach was then very much related, as Don said, and Chris also, that we were looking at the experiences of the financial crisis, and in our case, in Europe, the euro crisis. And then we had two things that were, say, clearly problematic as regards having preferable economic and policy outcomes. One was that the rates were hiked in spring 2011, summer 2011, in a situation where we had a short-term inflation peak, which of course we could see it only afterwards, but in any case, there was an energy price-related inflation peak, and the ECB Governing Council did not look through it, but reacted immediately because its strategy was telling it so that you should react in the short term. Now, we wanted to correct that, and that's why we took the medium-term orientation. I think it's still valid. I think it's valid for both directions, or from both directions in a way. The other one was that we had not sufficient fiscal monetary coordination during the euro crisis, which was also related to the premature rate hikes, because if you hike rates and you tighten monetary policy, then you squeeze the room in fiscal policy, which became a major problem as regards growth and employment in the Eurozone. So it's important to learn those past lessons, but I agree that currently we are in a different situation, and if I were an academic, I would, and I can recommend that to everybody, that there's one interesting research subject which one could look closely, and that's the question of sequencing in normalization, so that we have, for instance, we have different experiences already and different practices between the Fed and the ECB. Not dramatically different, but nevertheless somewhat different, and that could provide quite interesting raw material to analyze how normalization can be done and with which kind of sequencing in order to achieve optimal policy outcomes. Our approach now is, as I said in my opening remarks, is say parallel, so that on one hand we maintain our consistent gradual process of policy normalization, but at the same time we want to contain and counter any unwarranted financial fragmentation between the core and the periphery.
Dr. Cohn, as Governor Waller said, there's a lot of experience and wisdom even in your little finger. Could you just reflect for a moment on this issue of how to normalize?
Yeah, so I think ordinarily I would be in favor of a fairly gradual approach. And I think there are a couple of arguments in favor of that. One is we don't know where neutral is. There's a huge amount of uncertainty about where we're going. So to state confidently we need to go to X rate and then go there in 2 jumps, I think would be taking huge risks with the economy. I'm perhaps less worried, well, I would worry somewhat about the financial markets, but I'd worry about the macro economy as well, because if you guess wrong, then you've perhaps risen too high. You don't know. And the second point is, I think the forward guidance contributes to the ability to move gradually because you tighten financial conditions just by talking about it. And the federal funds rate is really just an index for financial conditions generally. Monetary policy works on demand through generalized financial conditions. The funds rate is one way of looking at that and say a Taylor rule, but it's a much more complex thing altogether. So I think the forward guidance is in some sense a substitute. You're right, you have to do what you say you're going to do if it turns out to be the right thing to do. But it has a tightening, and we're seeing that already, right? We're seeing a slowdown in mortgage market and housing starts from the tightening of financial conditions that began 4 or 5 months ago. The other thing, and I think what gradualism does do is it gives you a sense to get, because of uncertainty about where the neutral rate is, it gives you a sense to, how the economy is responding to the tightening of financial conditions. So I think there's something to be said and given our ignorance about how the economy reacts to monetary policy impulses, I think there's something to be said for gradualism. On the other hand, I agree that the forward guidance had kept you too constrained for too long, and you needed to catch up. So I didn't have a problem with what you did last week, but I do think there is an argument for not going so fast that the economy is reacting to your previous actions, the previous tightening, and you don't realize it until too late. And that's what got me a little bit worried about overstaying and doing too much under these circumstances. I don't, yeah, so we'll see.
Yes.
Just a brief comment and actually question to Don and Chris. From the European standpoint, as regards normalization and as regards forward guidance, I believe that forward guidance is relatively more effective when we are closer to the effective lower bound and disinflationary environment, while there should be a shift towards data dependency once we are in a more, say, high inflation environment. I don't know if you see it like this way, because obviously forward guidance and data dependency are or can be in somewhat in contradiction between themselves. So I would like to hear your views from the US standpoint.
That's what we just saw this last week is exactly that. We need to set policy based on the data. Your forward guidance is based on some forecast of the data, not the actual data. And when those two things don't match, you have to make a choice whether you're going to respond to the actual data or believe your forecast is that somehow that's noise and you can just look through it and stay with your forecast and stay with your forward guidance. And that was the kind of pinch we got ourselves in this week. Chair Powell had said we were planning on going 50 in June, 50 in July, based on our forecast. And then we get a CPI report that didn't match that forecast at all. And then you say, okay, now what do? Do you go with the data? Do you go with your forecast? And there was a sense in which, at least for me, I can't speak for the other committee members, but it's not clear that this inflation is going away next month or the month after. So the forecast has to change, therefore the policy has to change, and the forward guidance has to change. So whenever these situations arise, you're going to have this upsetting of people that, you said you were going to do X, and now suddenly you pull this rabbit out of the hat and go 75 instead of 50.
Right.
But that's what the data was telling us. We have to go with what the data is if we think that's going to persist. And that's my view of where we're going.
Following up on the idea of forecasts, let's look to the future a little bit and focus on the path back downwards, we all hope, from unacceptably high inflation to central bankers' target. The FOMC just released projections, dot diagram and otherwise, implying that inflation will come down, one might say, relatively sharply over the next couple of years during a period when, by some definitions, real interest rates will be still either negative or not terribly high in any case. And some would say, I think some people have published various blogs and so forth saying a classic Taylor rule would argue for going even higher than the FOMC predicted. So Governor Waller, can I start with you, then we'll go to Governor Wren. Can you help us to understand the reasoning behind the official forecast of what's going to happen with the inflation rate?
Well, when you want to think about the real policy rate, you don't want to look at today's rate and today's inflation.
Right.
That's not what people are making decisions on. They're looking out forward in terms of what's expected inflation going to be a year from now over the course of, say, some short-term loan, or a year and a half from now. And if you look at the pricing, market expectations are down as well for next year. And they have rates up high. So the real policy rate is expected to be high next year, or positive. So just looking at a simple Taylor rule of today's rate minus today's expected inflation, or actual inflation, that's just the wrong way to look at this. So there's a couple things. One is, and I tell you right now, I don't care what's causing inflation. It's too high, and it's my job to get it down. That's it. I don't want to get into supply and demand and all these arguments. We have to get it down, and we only have one way to do that, and that's raise rates. Now, two things. The higher rates and the path that we're putting them on is going to put, obviously, as Don was just mentioning, it's going to put downward pressure on demand across all sectors. And at the same time, if these supply factors slowly start easing or fading over the next 6 to 12 months, that'll help us come down. So I'm not counting on this anymore. I sure did a year ago, but I'm not counting on it anymore. So I've just got to get rates to the point where we're in restrictive territory. We can pull demand down. I don't want to cause a recession. That's not my goal. My goal is to just slow the economy down. Maybe we have to go below trend growth for 6 months to a year. That's okay. Maybe unemployment has to go up 4%, 4.5%. I think it would be 4 to 4.25. Could get worse. I can't control that in the sense of, but you know, right now we have not seen inflation like this in 40 years, and that's the most important thing we got to worry about.
Makes sense. Governor Wren, let's turn to you. Also, I'd like to ask about your thoughts on the path downwards for inflation, but I think you made an interesting point in your remarks that monetary policy is not a very effective mechanism for fighting high energy prices or energy price inflation, which is a significant part of the mix in Europe. So if that's not real responsive, how do you think about the path down in Europe, in the Eurozone?
I think, first of all, economic models or econometric models are not very good in capturing discontinuities or structural discontinuities or geopolitical shocks. And we are clearly we've seen actually two shocks. One was a health-related pandemic. The current one is a geopolitical shock, Russia's brutal war in Ukraine. And it is very difficult to predict whether this war will escalate or intensify. And that's in many ways the critical factor in determining how energy price inflation in Europe and to an extent globally will evolve. So that is certainly a major challenge in the European context. It is felt more in Europe than in the US, but as said, it is also a global issue. I see that in our case, the consistent, orderly, gradual process of monetary policy normalization makes sense and can work. I mean, nobody can be sure, but it can work. And Europe is in somewhat different situation as regards economic cycle compared to the US. The US has had a more rapid recovery and has a tighter labor market. In Europe, we have more slack still, and we have more differences between the member states. So to my mind, it makes sense that we continue this consistent gradual normalization, and at the same time we try to counter financial fragmentation. For us, it is of course the issue of whether we can help to slow down or contain inflation in a manner that will not lead to a recession, which we of course want to avoid. So we have a kind of a catch-22 or conflicting pressures in monetary policy. On one hand, we need to contain inflation expectations so that they will not be unanchored, but to do so in a way that we will not push the Eurozone economy into a recession, which we of course want to avoid, into a recession which would mean negative growth and higher unemployment. I think we can still avoid that recession, at least due to monetary policy, but it is going to be very tough and require very well calibrated monetary policy choices going forward.
Dr. Cohen, your turn. I'd love to ask how you think about forecasts, how fast inflation comes down, quoting Paul Volcker, how the heck do we get out of this mess, or how fast can we get out of this mess? What do you think?
So I think what the Federal Reserve has outlined in its projections is possible. Certainly what they should be shooting for, that Chris has outlined, growth below potential, small rise in unemployment rate, see what happens. I think one point to reinforce what Chris said about the federal funds rate and the current federal funds rate is that in the TIPS market, unless things have changed in the last few days, real rates are positive. And they're not far from estimates of, so 5 and 10-year real rates are positive. So the forward guidance that the Fed has given, both in its announcements and in speeches and in the projections, have raised those rates to positive levels. So I think that's very encouraging. What I would keep my eye on as we go forward in the next 2 years is labor markets. So I think that's the key. As demand shifts back from goods to services, many kinds of services are very labor intensive. We need to take the pressure off the labor markets. Governor Waller has given a speech suggesting how he thinks that this could happen by bringing vacancies down much more than bringing unemployment rate up. I hope he's right, but I think watching those wages, watching wage developments and labor market pressures will be key. So it's possible. Fingers are crossed.
So let's follow up on the labor market point quickly. We're running low on time, I'm sorry to say. I guess what I'd really love to ask you all briefly to comment on is what you think just might be the price to be paid to get back to the inflation target, really in a couple respects. One is, Governor Waller, I think you maybe might want to take up what Dr. Cohn just spoke to, the speech he recently gave about what actually happens with the unemployment rate. And the other question, I think, is what actually happens with wages, given the lag that they have had relative to the increases in the prices of goods and services. So do we, presumably somewhere out there there's a catch-up, but do we potentially risk not experiencing the catch-up for a while in the context of tightening? Governor Waller.
Yeah, so I mean, it's very hard to convey to people how tight the labor market is right now. I mean, the unemployment rate is at 3.6%, has been staying there. We've had job growth of close to 500,000 jobs a month, every month this spring. These are staggering numbers. So the labor market's amazing. There are 2 jobs available for every unemployed worker looking for a job. Normally, that number is 1 job for 2 workers looking. So this is amazing amount of, I'm going to just use the phrase excess demand for labor. So that excess demand has an influence on wages and driving up wages, passing on cost, that firms have to absorb these wages. So there's a sense in which if we could just push down total demand for goods and services from the households, that's going to lead to a decrease in labor demand. And then the firms have 2 choices. They can pull back on how many workers they're looking for, or they can lay off the existing workers that they have. So my kind of thinking and reasoning is the first thing you can do is pull that excess demand down by lowering vacancies. You don't have to actually lay anybody off. And that will take some pressure off markets, that'll take some pressure off wages, and that'll cool things down. So that's the argument in this speech I gave about 2 weeks ago, that if you can just drive down vacancies, you don't necessarily have to have a big impact on employment, and that'll take some of the steam off of the labor market. But this kind of massive fear of a recession from raising rates up to 3.25% just seems a bit overblown. I have to sit there and I look, now the first quarter we had a minus 1.5% GDP growth number, but that was all driven by exports and inventory changes. Underlying consumption investment was growing at 4.5%. So the core part of demand was strong. We're starting to see numbers for the second quarter being very low, maybe even close to 0, which always raises a puzzle for economists. If you just hired 2 million workers, new workers, and you're getting no output, what's going on? Right. I can't quite square the employment numbers with the GDP growth numbers. So we're kind of looking under the hood as like, are these low GDP numbers, these odd factors like inventory adjustment or just changes in imports and exports and not really consumption investment, which drive a large part of the economy?
Governor Wren and Dr. Cohn, briefly, your thoughts? Do we avoid a recession in both continents? Dr. Wren first.
I think we have a chance to avoid a recession, at least in the Eurozone. I can speak on behalf of the Eurozone in this context. And the way to do so is with a well-calibrated normalization of monetary policy and at the same time gradually also reducing the support from the fiscal policy side, which has been quite strong also in Europe. Concerning the labor market, we have two differences. One is that the participation rate in Europe did not go down during the pandemic too much, partly because there were less layoffs and there was the use of furlough schemes in Europe. So instead of social security checks, we relied on unemployment benefits and furlough schemes, and there was less hysteresis in the European labor market, which now pays off in a sense that the participation rate has actually been quite solid and good. The other thing is that it paradoxically may be related to the current situation, may be related to the rigidities in Europe, if you know the discussion in the political economy literature. So you have flexible labor markets in the US, you have rigid labor markets in Europe. So while you have your Great Resignation and 6% wage increases on average, depending on the sector, we have our unions who are actually maintaining calm for the moment. I'm not saying that forever, but until recently, so that wage increases have been in the scale of roughly 3% on average, which is not, say, overblown in the context if you have inflation rate, the current inflation rate at 8 or 6.8. So we have a chance to avoid a recession, and in Europe we are in a little bit different situation than in the US.
Dr. Cohn, can you bring us home in just a couple sentences?
Sure. So I think one thing to remember in terms of the inflation, the recession risk is that we've got the declining real incomes because of the supply shock that's contributing to those concerns. So it's not just the tightening of monetary policy, but I think it's possible. But it will be possible to escape recession by keeping those expectations anchored. So no bad inflation news. Expectations remain anchored, supply side cooperates, at least it doesn't make things worse and maybe makes things a little better, and that'll make it much easier for the Fed and for the economy to recover.
Well, I would suggest to everyone that Governor Waller and Governor Wren have certainly helped to illuminate the ways their jobs are terribly complex these days, but also the determination of both the Federal Reserve and the ECB to tackle the challenges that we're facing in a swift and decisive way. And I think Dr. Cohn, I guess I would also say, had a really important point that I hope everyone will take away, which is we can take some heart from the fact that our central banks are data dependent, adaptive, and are having very active real-time conversations about how we tackle the challenges of our time. So on that note, I would like to thank the Federal Reserve Bank of Dallas and SMU for bringing us all together. I'd like to thank President Black. Thank all of you all for coming. I'd like to ask you in joining me in thanking our distinguished panelists. There's a reception right outside the door right now. We'll see you there.